Hey everyone, welcome back. Chapter 11, Capital Investment Analysis. Okay, capital investment analysis is defined as the process by which management plans, evaluates, and controls investments in fixed assets, long-term investments. All right, and that's taken directly from your book, your Cengage book there. The idea with the capital investment analysis is you have to decide where you're going to spend your money when you have it. Does it make more sense to expand our factory? Does it make more sense to upgrade our cars, right? How do we make those decisions? Well, there's going to be a couple of different ways that we analyze those decisions, those choices, and they're going to be broken down into methods that don't use present value and methods that do use present value. Okay, so if we're trying to evaluate whether to spend our money or where to invest extra money that we have or some of our earnings, we have to decide what's going to give us the most bang for our buck, right? What's going to have the greatest return to us, all right? Which is going to, turn around, which is going to pay us back the fastest for our investment. All right, so like I said, we're going to break that into two different categories. Ones that don't use present value, and what present value is if you may have heard of the time value of money. If you haven't, you will today. But there are a couple of methods that don't use present value. They're better if you have short, useful lives for the investments, because present value and the time value of money really comes into play. Well, it is a really important concept, the idea of that money has, I don't want to get ahead of myself. Money has a time value on it, meaning that it's worth more today than it is tomorrow. And I'm not going to start there until we get to that section of these slides. But the longer an investment is, imagine it's a 10-year, 20-year investment, you are going to want to consider present value because there is a time component. Okay, so for, you can use the present value method, the net present value method, which is the most popular on a short-term investment. It's totally fine. But if you're just trying to do, decide between maybe two alternatives, one's a 2-year thing and another's a 3-year thing, you might simply use one that doesn't use present value. And those are the average rate of return, the cash payback method. All right. But the most popular of them all, because time value is an important concept, is that net present value method. And we are going to spend most of our time here. I'm going to show you these first two. We'll put most of our time here, and I don't really talk about internal rate of return too much, which also means you're not tested on it, which also means there's no homework on it, so don't worry about that. But I'm spending most of my time here because this is the most popular method to use. Okay, so let's just even start. Average rate of return. Average rate of return is calculated as average annual income divided by average investment. Well, average annual income is going to be your annual income minus any depreciation. Okay, so hold on to that for a minute until we get to numbers, and I'll show you why that's important. Your denominator here, average investment, this is how much you're planning on putting into the asset that you're buying or the investment that you're making. So the idea is you're going to have a beginning value plus an ending value divided by 2, because that's your average, right? How much am I buying this? Let's say it's a piece of equipment. How much am I buying this piece of equipment for? What's the value going to be done? What's the value of the equipment at the time that I'm done with it? So the residual value. Average those by dividing it by 2. Okay, so don't worry, we'll get to some numbers. There's pros and cons to each one of these. The pros, the average rate of return, is easy to use. It's easy to compute, easy to use. It includes income over the whole life of the proposal. Cons, it doesn't consider cash flows and doesn't consider any timing, meaning it's not using the time value of money piece. Now that's fine, we know that going into it. We know that it's a quick method. So let's get right into an example so I can show you how this works. Let me get rid of this little notepad here. Okay, average rate of return. I've got 2 of them in here. All right, average rate of return. So determine the average rate of return for a project that's estimated to yield total income of $170,000 over 5 years, has a cost of $320,000, and has a $20,000 residual value. Okay, so if we went back to that formula, it was average annual income, right? This is income of $170,000 over 5 years. Ooh, my pen doesn't want to work because I'm using it upside down. All right, here we go. $170,000 over 5 years. So if I'm looking for the annual income, I'm going to take $170,000 divided by 5 years. And that is going to be $34,000 per year. Okay, so my numerator is going to be 34,000. My denominator is going to be the average investment. Well, the investment has a cost of $320, so that's its beginning value. 320,000 plus it has a 20,000 residual value, meaning that's the value at the end of its useful life, 20,000. And we're going to divide it by 2 to come up with the average there. So that comes out to be an average rate of return of 20%. Is that good? Is that bad? I think it's probably pretty good. However, you're not doing these things in isolation, right? You're comparing it usually to something else. What is my average rate of return if I were going to do this project? What's the average rate of return if I was going to do a different project? And so it's really a comparison thing, like it's comparable between the two. All right, so that's kind of average rate of return. However, there is a problem that, since I've taught this for quite a few years, there is a problem that you are going to have in your homework, and I'm not going to do it for you, but I'm going to help you get started on it because it's one that students typically have a problem with. Okay, and it is the average rate of return, same formula, but it takes a little bit more work to get into the math on this formula. All right, so we have the same idea. Midwest Fabricators is considering investment in equipment that will replace direct labor, right? So you're basically buying a piece of equipment to replace an employee. We're not here to get into ethics of that. The equipment has a cost of $132,000 with a $16,000 residual value and a 10-year life. Okay, so let's just grab that information because that's our denominator. We have that. That's good. All right, we know the beginning value and we know the ending value of the useful life of this equipment. 132 plus 16,000 divided by 2. Okay, so I'm not going to get into the math on that yet. I just wanted to kind of grab that information. It also has a 10-year life. That's going to become a factor in a minute. The equipment will replace one employee who has an average wage of $34,000 per year. In addition, the equipment will have an operating and energy cost of $53.80 per year. Okay, so now to come up with the beginning is supposed to be your annual income, right? But if you remember, I added more to that above. I said it was the annual income minus any depreciation as your numerator, okay? So let's work on this annual income component here. The annual income, you're not like generating money from this machine. However, you are saving some money, right? You're saving that employee's wages of $34,000 per year. So that's extra income to you. That's where that comes into play. All right. You are also going to have to pay for maintenance on the machine, right? $53.80 per year. All right, and I grab that from right here. Ooh, I'm on the keyboard. Okay, move myself a little bit. Now we also have to subtract the depreciation piece. I don't think it tells you. Oh yeah, it tells you straight line. We've got straight line depreciation on this investment. So now you have to kind of remember, reach way back in your brains to straight line depreciation. I think my husband's going along. All right, so the equipment is $132,000. It's got a residual value of $16,000, right? So cost minus residual value over the lifetime of the asset, or the useful period of the asset, however you want to look at it. That comes out to be $11,600 in depreciation every year. So you're going to have to subtract that $11,600 as well. And that'll give you the annual income number now of $17,020. And that's going to come right on up here, $17,020. All right, I'm going to stop there. You can complete the rest of the problem on your own, but I know that's typically a sticking point for students is how to come up with that, right? A little bit more complicated than this little guy up here. So I wanted to give you like a good example. All right, so let's move it along. That was average income, average annual, not average age, average rate of return. Okay, cash payback method. Cash payback method, how long does it take to get your money back? How long will it take to recoup the money that you put into this investment? So if it's a $100,000 investment, how long is it going to take for me to get my $100,000 back? So really what we're looking at is we're looking at the time component here. How long is it going to take me to get my money back? Easy to compute. You look at cash flows. We don't deal with cash flows after the payback period. We're only concerned about how long is it going to take me to get my money back. It could still continue to earn money for us, whatever our investment is, but we're only concerned about a time period here. Is it going to take me 1 year? Is it going to take me 5 years? How long is it going to take me to get my money back? And we don't use present value concepts. We know that going in. Okay, so let's look at an example. Project has estimated annual cash flows. Oh, here's your formula, sorry. initial cost divided by the annual net cash inflow, right? Easy example of this. Let's say you bought a piece of equipment, $30,000. Let's just make up numbers here. The initial cost of the equipment, let's say, is $30,000. And this equipment is going to generate for me $10,000 a year in income. Well, then it's going to take me 3 years to get my money back. It's a terrible 3. Okay. Get the idea? Pretty simple. Pretty straightforward. So here we go. Project has an estimated annual net cash flows of $36,500. Its estimated cost us $222,650. How long is it going to take us to get that money back? Well, the equipment is $222,650 divided by $36,500. You do the math, 6.1 years. That's how long it's going to take us to pay us back. Okay, so it's that simple. It doesn't need to be more complicated than that. It's a simple little calculation. Okay, so I'm going to stop this now before we get into the present value methods. Very exciting. Next. To be continued.